It's probably the million-dollar question that almost every investor has on their mind at the moment. Are we headed into a recession? When could it happen? And what will it look like if it does? Everyone's talking about the yield curve inversion as if it's the sign of the end of the world.
Market shouldn't be going up.
Inflation is out of control and central banks are now tightening their belts again. So are we really about to enter into another downturn into the economy? Are those stock market bears finally going to get their wish? And what should we do about it if the worst was to happen? Let's start from the top.
Sell, sell, sell. Rates flying higher. Sell, sell, sell. The specter of companies missing estimates. Sell, sell, sell. A behind-the-curve Federal Reserve. Sell, sell, sell. They know nothing.
Recessions are not something that you really want to happen, and technically they're defined as any period of 2 quarters in a row of negative GDP growth. However, on top of that technical definition, there are some more factors, and over in the US, the National Bureau of Economic Research says that a recession needs to be a significant decline in economic activity spread across the market, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Clearly that's a mouthful and we don't want to get too technical, so we'll translate this as things slowing down, people spending less, business spending less, people losing their jobs, and so on. The last recession we had may not even really be called one through the pandemic in 2020 because it happened so quickly. But before then, the most recent one that most of us would have gone through would have been the financial crisis of 2008. This was the worst since the Great Depression of the 1930s. It started in December 2007 and lasted all the way through to June 2009. Millions of people lost their jobs, unemployment rose to 10%, and central banks had to spend trillions of dollars to prop up failed banks and secure mortgages. Here in the UK, the Bank of England made unprecedented moves, stepping in to protect depositors of banks like Northern Rock, HBOS and Lloyds. The fallout of the crisis caused a large number of changes to be made in the UK, with new regulations put in place with a lot more oversight by bodies like the Financial Conduct Authority. It was to be the end of easy money and people getting more than 100% mortgages. How that was even a thing still confuses me. So all good then. Surely that means that it's less likely to happen again. And if it were to happen, we already know what central banks around the world will just throw money at the problem with everyone's favourite financial tool, quantitative easing. In other words, the economy looks bad, central banks buy government bonds, which is as close to printing money as you get. Maybe, maybe not. But here's why people are getting worried at the moment, and it all stems from what the economists call leading indicators. You know when you get an indicator light on your dashboard of your car with a big engine sign? Chances are that you need to get it looked at. It could also mean a false alarm, and it could have just been triggered because of a sensor's failed, but most of the time, you'll probably want to do something about it. Here's where in the financial world, the yield curve comes in.
And the yield curve inversion.
We inverted back in March.
Yes, we now have an inversion.
Even if the yield curve inversion happens again and happens persistently.
The president tweeting out crazy inverted yield curve.
You see, in the world of finance, government bonds are very important. If I lend the government money and buy a bond, in return I'll receive a reward in the form of interest. Typically these bonds come in all shapes and sizes, some are short term and some are long term. In a normal economy, a long term bond would give me more interest back. This is because I'm agreeing to tie up my cash today, which carries with it some risk, and I know that money in the future is going to be worth less because of inflation. With bonds, the return you get, called the yield, is the opposite of its price. If more people buy one type of bond, the yield goes down. And the same in reverse. When less people buy a bond, the yield increases, as there's only so much money in each pot to go around. Pretty much the same as if you buy a dividend stock, the yield changes depending on the price of the share. Let me explain what happens during a yield curve inversion, but rather than just sit here and do it, I'm going to take inspiration from the film The Big Short. Remember when they got attractive celebrities to explain complex financial concepts? Well, I'm going to try and recreate it, but without any budget at all. Bear with me. Hi there, I'm a short-term bond. People like to buy me because I'll give them 1% interest on their money. Putting your money here has very little risk because my government always pays the bills. Oh, who's this? Hi there, I'm a long-term bond. I'll give you 2% interest on your money right now as a reward for putting away your money for a longer time period. The choice is up to you. Right, so we have our bonds. Imagine a line drawn between the two of these showing an upward trend. This is what we would normally expect. The longer the term of the bond, the greater the rewards from the interest payment. It's all driven with supply and demand. If more people buy the bond, the yield goes down. Here's where the problem comes in though, and what economists don't necessarily like. Campbell Harvey is the person responsible for this. He wrote this university dissertation on this topic back in the 1980s, and he noticed that when the difference between the US 10-year bond and the 3-month bond yield flattens, or worse yet, inverts, meaning that the yield is better on short-term bonds compared to longer-term ones, this is a signal of a coming recession in the next 7 to 24 months. In fact, since 1955, the stock market has peaked 6 times after the start of an inversion, and the economy has fallen into recession every time during that 7 to 24 month time period. So not looking good then, it's just a matter of time. Oh, you bond yield guys can go now. Thanks for the help. Your check's in the post. Don't forget to drop them a like on the way out, they always appreciate it. Why was that important? Well, if more people are choosing to place their money into long-term bonds, including foreign investors and big institutions, this suggests that the near-term future is not so pretty. These investors are expecting interest rates to rise, growth to slow down, and generally bad market to invest in, especially when looking at other things like companies, so they choose bonds instead. Also, let's not forget that the buyers of the long-term bonds include the central banks. So in the US, for example, this is the Fed, which means that the long-term yield is being kept artificially lower because of all of the spending in this space. To put some perspective on this, the US central bank has injected more than $4 trillion into the economy through the purchases of bonds since March 2020, which has doubled its balance sheet. And from a UK perspective, the Bank of England now holds nearly £1 trillion worth of government debt, and you can see how this purchasing has increased all the way back to 2009. Let's not be so quick to worry though, there have been a couple of false positives. You can't have predicted 2020, for example. Things that might cause a recession may not be so obvious, otherwise we'd all just be preparing for one all of the time. What about other indicators then? How's everything else looking that might signal a downturn? What about things like employment or job vacancies or even company earnings expectations? All of these things matter too. Well, let's tackle jobs first, and we can look at the data from both here in the UK and over in the US. And this is always important because, as they say, being the largest economy in the world means that if the US sneezes, the world catches a cold.
Sell, sell, sell.
Looking at the most recent US job data, you'll see that we're almost at pre-pandemic levels on the payroll. The latest figures show another several 100,000 people in work when we look at compared to February to March. No slowdown there then. And what about the UK? Are we pretty much the same? Well, we've just seen a record number of vacancies with a huge number of positions yet to be filled, and we've got increasing numbers of people in employment, although we're not quite where we were prior to the pandemic of 2020. Now, this isn't a sign in itself. If we were just to have a recession, we would see people lose their jobs during the recession, not before. But we are looking for slowdowns, and I'm not seeing anything from this information. Even big company earnings are yet to show any slowdown. Just look at big companies who make up a huge part of the stock market, like Apple, Microsoft, and Google, for example. All of them seem to be delivering record numbers from their latest results. They're still growing, and there's demand for services around the world from consumers and businesses. Just look at last quarter's results from Apple, with record sales, profit numbers, services, revenues, and profits. In the event of any slowdown which would signal any kind of economic recession, surely we'd need to be seeing earnings be reduced from the leaders in the market, especially if what they produce are consumer goods. Who knows though, that's just my assessment. Before this video gets too long though and too boring, there are loads of indicators out there which I've looked into, and no doubt full-time economists can give you an even better take. The bottom line is though, as much as we all have so much data to look at, there's not a single way, that I found at least, that can predict a recession with any kind of certainty. There's just too many factors at play in the economy, many of which we're unaware of and don't even consider at the time. We do know that they're somewhat inevitable though. In the boom and the bust cycles of expansion and recession, the stock market is always in some kind of cycle, but where exactly, who knows. The one thing that we can take away from all of this though, is that regardless of the ups and downs, the overall trend remains in one direction, and that is up. And this brings me on to the next part of the video. What can we actually do about them, and what are my plans if we do fall into recession here in the UK and around the world? In terms of preparation, there's not a huge amount you can do to stop a recession, but you can make your own circumstances better to ensure that the pain caused is a bit reduced. This just comes down to good old-fashioned, well-organised personal finances. Having things like an emergency fund or just some kind of access to cash that can cover bills and expenses becomes essential, especially important if you end up losing your job, because the last thing you want to do is have to sell your other assets like your home or your shares, because you're in a lose-lose situation if you do that. If possible, cut back on expenses that are excessive. I used to spend quite a lot on flashy cars and clothes, but after realising what a waste of money they were, I'm much happier not having to pay that burden every month. Paying 20 quid road tax is a lot nicer than hundreds, and having a cheaper insurance bill is also another nice perk. Now comes the interesting part. What are my plans if we do enter into one? Well, you'll be glad to know that almost nothing changes. If anything, if you can stomach it, and you're in a fortunate position, you may want to increase your investing and your dollar cost averaging into the market, especially during these downturns. Or if you're just happy to set and forget and you're still building your wealth, then consider anything you invest during that recession the same way as buying something on sale in the supermarket. If you were told you could go back to the start of the pandemic and choose your investments all over again, I bet you'd be very happy to do it, because you realise that as bad as things seem when things are going down, there will come an inevitable shift upwards. How long this will take to happen and when is another matter, and we know that some of the best days in the market have come very soon after some of the worst ones. Where things could get interesting though is if you've picked some riskier investments in companies which were not making much profit. Then you might see some lose everything or even go bust, especially as things get tougher and they're less able to raise money. When I talk about investing in dollar cost averaging every month, I'm really talking here about using low cost index funds that broadly track the stock market. No amount of dollar cost averaging will save you if your favourite stock pick is running out of money and can no longer survive, I'm afraid.
Sell, sell, sell.
Remember that in times of high interest rates and inflation taking over, there'll be less money going towards speculative stocks, and investors are likely going to flood those companies with plenty of cash flows and high profitability. But saying that, you don't have to worry about any of those things if you're tracking the market with an index fund. So the message remains, keep calm and carry on. You've got to accept that there may be recessions and downturns. Have that as all part of your plan. Understand that they do and will happen again. We just have no idea when they will. Even if the indicator's right and we get one in the next 12 months, who knows what kind of stock market rally we might see then before then. Staying on the sidelines waiting for a crash is almost certainly not the thing to be doing, and we've seen time and time again how the story ends. You can easily miss some of the best days in the market. Don't sit this one out, I've learned the hard way too many times. Find what works for you and stay safe out there. Remember, this is just my opinion, I'm not in any way a professional financial advisor. If you've enjoyed this video and you're looking at things to invest in that will help see you through any possible recession, check out one of my most popular videos which looks at some of the best Vanguard index funds that you can invest in, which are great for both beginners and experienced investors alike. It will be up on screen now, either here or here. Until then, thanks so much for watching. Drop me a big fat like if you've enjoyed the video, subscribe for many more, I'll see you in the next one, and as always, happy investing.